Hey, welcome back, everybody. And so, yes, we're back in Chelan. And yes, we're about ready to embark on some more, I would say, fun activities. So, wanted to get your video out really quick. And today's title, right? It's the whoops. Are the Feds about ready to do a repeat? Are we going to see what we saw last year? What the heck is going to be going on? Let's just find out. All right, so let's pull up this headline right here, and it says, listen to this. You know what? Listings are on the rise. Mortgage rates hit a 24-month low, and it says more sellers are putting their homes on the market as mortgage rates fall significantly. But look at the date. That's October of last year. Now, you might be saying, George, where's the relevance here? Well, funny enough, that's exactly where we're at today. We're going to get into what's going on with the Feds. What are we anticipating for September? What's going to happen with rates? What happened last year, which appears to be very much a mirror of what we're seeing today. So as we pop over, let's take a look at some of these headlines. So look at that. Refi demand surges as rates hit longer-term lows. You can see by the upper right-hand corner, we've been heading in a downward trend. In fact, par pricing today is about 6.5%. And when you take a look at, where we've been, over the last, I would say few months, we've been in the high sixes, low sevens. Now we're in the low sixes. And in fact, last year at this time, if let me pop over here, when we take a look at Freddie, let me get myself out of the way. There we go. Look at that. So remember, last week we mentioned that our rates are going to see a little bit of a change from year over year. And then the left-hand side, last year, as we headed into August and September, we were at 6.08. That's exactly where we were seeing the lowest rates. But the Feds also did what's called a half a point, or they did a 0.5% decrease in the Fed rate, which has nothing to do with mortgage rates, but they did a 0.5% reduction in the Fed rate, but mortgage rates shot up. And we have seen that very consistent pattern over the last 4 price reductions that the Feds have done. They are very hesitant about it because the market's a little bit more volatile, even though some of the reporting came in, which helped out mortgage rates because big investors started investing more in bonds. Bond rates went up, mortgage rates came down. And that is the trend that we've been seeing. But that might change if the Feds do a quarter rate drop in September, which is entirely possible, right? Okay, so if we then take a look at what is the next big thing, if we take a look at what we call our running 7-day average, here's what's super interesting. Market times are up 7 days. That's the upper chart here. We're up 7 days year over year for the same month of August. Basically about the same. It's 5 days year to date. Interestingly enough, we're seeing a 97% list to sales price. So that means if I listed $100,000 and I sell at $100,000, that means that I have 100% list to sales price. If I list at $100,000, but I sell at $97,000, that gives me a 97% list to sales price. That is what we're looking at right now. We're seeing a little bit of a pullback, and when we take a look at the running 7-day average for the Northwest MLS, let's change that chart there. You can see that we've had basically 1,033 homes that came on market, 1,152 that went off market. And that's super important to understand, because what we're seeing then is more homes are coming or more homes are going off market than coming on market because we've seen rates drop down. That is situation normal. That is normally how we see it. And it is seasonally consistent for today. And that will start to slow down as we get towards the end of August, because we've got Labor Day weekend. We have people taking last minute vacations. We got kids getting back in school, college students getting back in school. And people starting to take a mind shift of doing other things before the snow flies. Anyway, there we go. Seasonally normal. And when we take a look at some of those numbers, it's all right. So let's take a look at the Northwest MLS. Let's take a look at what we're going to do numbers-wise. So as we can see here, the middle chart is showing us that our average sales price is actually up really well. And it's bumping up and including our year-to-date. The upper chart, you can see where we were at last year. And you can see that we are trending higher, not only in list price, but the average sales price. Year-to-date, a little over 1%, which is a good trend. So if we pull this up and we look at it as far as our actual velocity, what is the number of transactions coming on market, going off market? Look, we're super well balanced. The upper chart you can see is our year to date. We're up 1.1% as far as overall sales volume for single family homes, and we're up 2.3% for pendant. Now, when we take a look at for just the month of August, year over year, we're down just a little bit on the actual closings, and we have an increase in the number of pendant. Now, what's important about that is that, remember, when we talk about August closings, right, we're actually talking about July's contracts. So remember, the first part of July, we were really lagging, but the latter half of July, we actually had some marketable improvement because rates were coming down. So as we see rates coming down, we see more pendant sales, we'll see more closed sales. So as we move through the month of August, our sold numbers are actually going to start improving, which is, again, seasonally normal. All right. So if we take a look at this, we know that we have our inventory, which would be between 20 and 22,000, as low as 18. We at 17,000 year to date. We're getting closer to where we were at, but we're still, again, very much a balanced market. We are not swinging really in any way or the other. We just happen to see more sales volume right now because we have lower interest rates. That will shift if we, pop back up into the sevens or real high sixes again. That will slow down, which is, again, absolutely normal. So as we roll over, let's take a look at our new construction. So new construction, our numbers, again, are improving. These guys have been making up some headway. As you can see, the average sold price is definitely up year over year at 2.3%. And then, of course, we're up a little bit, just for the month of August. The upper chart, you can see where we were at last year versus the right-hand part of that upper chart where you can see where we're at today. But when we take a look at actual sales volume, okay, so this is where they kind of suffer, even though they're holding steady on price, a lot of which is based on incentives. You can see that, the number of listings, the upper chart is down. And even year to date, we're seeing some lesser sales, lesser pendants, except for the month of August. We're up just a little bit. And interestingly enough, as we see that trend happen, again, you might be saying, George, why are their pendants starting to slack off? Well, it's because we've had more resale inventory that is pulling eyeballs away from new construction, even though they're offering some really good incentives. And that's totally normal. And, well, it happened earlier this year. It's happening now. And as people get more choices because they don't want to be, further out, they want to be a little bit closer in. And by doing so, right, they can go ahead and continue to offer those incentives, because once rates go up, or if the Feds drop and mortgage rates go up, builders are going to be, again, a more dominant option. They have better rates and things like that, different incentives. All right. In fact, Lennar is offering a zero down program in some of their outlying projects, because with the return to work, more people are wanting to return closer into work, knowing that a drive time and fuel costs and whatnot offset each other on a house. All right. Anyway, moving on. Let's move over to, where we go. Bank owned. Bank owned, again, super boring. Why is it super boring? Because, again, we just don't have that many foreclosures altogether. That is just a smattering. We're one of the fewest foreclosure home, bank-owned home states. In fact, I think we're like third from the bottom, fourth from the bottom, which is we're exactly where we want to be. And in fact, when you look at these numbers, as we saw from last week, there's a number of these homes that we strike out that are not really foreclosures. They are just mismarked listings, unfortunately. And yes, we do go out to them and explain. But here at the end of the day, for banks, this is excellent news because they do not have a ton of inventory. And in fact, most banks, they will go in, they'll do paint, carpet, and vinyl. They get it back on the market again, and they can get market value for these. And in fact, their sales times have dropped a little bit because they're pricing themselves a little bit better, which is super smart. So if you're thinking that a foreclosure is a really great investment, not really. It's not. There are other options. There are fixers and more. I would consider, there's more fixers and good classification that you can go and do the same thing and get a better price because, again, you're not dealing with an industrial seller. Anyway, if you have any questions, absolutely let me know. In the meantime, you guys have a beautiful weekend. We're going to be doing some fly fishing. If you ever want to go, reach out to me. Anyway, from Chelan, I bid you guys an absolutely fabulous weekend, and I'll see you on the next video. Take care.